In 2 days in March 2021, one man lost more money than anyone in the history of markets, around $20 billion. He was not a bank, he was not a fund anyone had heard of, and he did not own a single share of the stocks that destroyed him. Everybody remembers the banks. $10 billion of losses, spread across 6 of them. Almost nobody remembers the shape of it, because Bill Hwang didn't hide anything. He didn't forge a document. He didn't break into a system. He didn't lie to a regulator. Every position he held was invisible by design, and the design was legal. Sung-Kook Hwang, who called himself Bill, learned the business at Tiger Management. In 2001, he opened his own fund, Tiger Asia. It ran up to $8 billion. Then, in 2012, Tiger Asia pleaded guilty to wire fraud over insider trading in Chinese bank shares. Hong Kong banned him from its market. So he gave the outside money back, kept his own, and reopened as a family office. Archegos, a family office, manages one family's money, and in the United States, it does not have to register with the SEC. Here is how he became invisible. Instead of buying a share, Archegos signed a contract with a bank. The bank buys the share and holds it. Archegos takes the gain if it rises and pays the loss if it falls. It is called a total return swap. On paper, the bank is the owner. Archegos owns only the outcome. So when the shareholder registers are published, Archegos is not on them. It never was. There's a line in American law. At 5%, cross it, and you have to tell the market who you are. So Archegos bought ordinary shares right up to the edge of 5%. And switched to swaps for everything above it. Someone inside the firm ran a daily report, just to make sure the line was never crossed. By March 2021, the SEC says Archegos had exposure to more than half of Viacom CBS, over 70% of GSX. It had never filed a single disclosure. It didn't have to. On Monday, the 22nd of March, Viacom CBS announced it was selling $3 billion of new stock. The stock fell 9% on Tuesday, 23% on Wednesday. By Wednesday evening, Archegos told its banks it could not meet the next day's margin calls, $10.7 billion. On Thursday, it ran out of cash. On Friday, the bank started selling $36 billion of his own capital against $160 billion of exposure, gone inside a week, and it took $10 billion of the bank's money with it. Now, a family office doesn't create leverage. Banks do. Somebody had to lend him $4 for everyone he had and keep lending after they could see what he was doing. So the question isn't how Bill Hwang got to $160 billion, it's why nobody made him stop. In 2019, Archegos went to Credit Suisse and asked for a better price. It said a rival prime broker was offering cheaper terms. Credit Suisse was charging 15 to 25% margin on his swaps. It cut him to 7.5%. And then it applied the new rate backwards to trades already on the books, which meant the bank had to send him money back. There was a second thing about those swaps, and it mattered more than the rate. The margin was static. It was calculated once on the day the trade was written, on the value that day, and then it never moved again. If the position doubled, the collateral behind it did not. Archegos wrote its swaps on 2-year terms and let them run. By September 2020, the average margin across his swap book had drifted down to 5.9%. Credit Suisse was the only one of his prime brokers not adjusting margin as positions grew. Someone at the bank found that out on a routine due diligence call. Nothing changed for 4 months. Every client has a limit. Archegos had one too. Potential exposure, $20 million. By August 2020, it was $528 million, 26 times the line. And the system did flag it. It flagged it as an excess requiring remediation, and it kept flagging it for 169 days. What the bank did instead was change the measurement. When Archegos kept breaking the stress test, the head of the Prime Services risk team asked to move him onto a gentler one, a 20% shock instead of 30%. Risk agreed. He breached that too at 209% within a month. When the exposure limit was in the way, the limit went up. 20 million to 50 million signed off in February 2021, which on paper cured the breach. A committee approved a temporary increase in risk appetite because, in its own words, a sudden rise in margin might do irreversible damage to the client relationship. In 2020, Archegos earned Credit Suisse about $16 million. $16 million a year. That's what the relationship was worth, against a position the bank's own risk committee would later measure at $20 billion. And here's the part that stops you. The people who should have said no had already left the building. Between 2015 and 2020, Credit Suisse cut its prime services headcount in the Americas by 44%, managing directors by more than half. Across the whole bank, 40% of the managing directors in risk were gone by March 2021, most of them not by choice. In February 2020, the head of prime services risk died in an accident. The man they put in his place had spent 13 years in sales and marketing. He had never worked in a risk role anywhere, and one of the accounts he had personally covered as a salesman was Archegos. In September 2020, a risk analyst wrote to his own supervisor about it. Quote, "All of the people that I would trust to have a backbone and push back on a coverage person asking for zero margin on a heaping pile are gone. The team is run by a salesperson learning the role from people that do not include the folks I listed above. I don't consider prime services risk the best first line of defense function anymore." End quote. His supervisor agreed with him. They asked prime services how it was going and were told progress was being made. That is where it ended. 5 weeks before the collapse, somebody inside the bank described exactly how it would happen. The 18th of February 2021, a risk analyst writes to the head of prime services risk. "Archegos has no lockup," he says. "Nothing stops any broker from pulling out at any time. And if there is an issue, all brokers would be looking to exit simultaneously, raise margin everywhere at once, and this could, in theory, force a liquidation." He said they should try and act soon. The reply he got was about something else entirely. The head of prime services risk later said he never focused on that part of the message. It was never passed to anyone above him. 3 weeks later, when the risk committee met to discuss Archegos, that was not on the agenda. That's the bomb under the table. For the last 5 weeks, the ending was already written down in an email inside the bank that would lose the most. And in those 5 weeks, the bank did the opposite of everything in it. On the 12th of March, an analyst told a trader not to renew Archegos' swaps until the margin terms were fixed. The instruction never reached the middle office. $13 billion of swaps were rolled for another 2 years at the old rate by a junior employee, apparently by mistake. Between the 11th and the 19th of March, Archegos asked for its excess collateral back day after day. 740 million, 650, 200, 76, 145, 230, 400, $2.4 billion paid out of the bank to the client in 9 days. Both of the analysts who had raised the alarms approved every one of those requests. Monday, the 22nd of March. Viacom CBS announces it will sell $3 billion of new stock. Archegos held exposure to more than half the company. New shares mean a lower price, and the deal priced at $85, below where the stock had been trading. Tuesday, it fell 9%. Wednesday, it fell 23%. In one day, Archegos' capital dropped 48%, from $32 billion to under 17. On Thursday night, Bill Hwang got his lenders onto one phone call, and he told them the truth. For the first time, $120 billion of gross exposure and $9 to $10 billion of equity left. Then he asked them to agree not to default him, while he sold it down himself. An orderly unwind. Everybody loses less. They said no. The maths of that call is simple. Whoever sells first sells into a market that does not know yet. Whoever sells last sells into the wreckage. That evening, Morgan Stanley moved about $5 billion of the stock to a handful of hedge funds at a fixed discount. On Friday morning, Goldman Sachs went out with $6.5 billion before the American Open and another $4 during the day. Deutsche Bank moved $4 billion in a single private trade, roughly $20 billion of stock in one session. Viacom CBS closed down 27% at $48, a 44% discount to the offering that had priced 2 days earlier. Discovery closed down 27% as well. 0-0 Goldman Sachs got out clean. Deutsche Bank got out clean. Wells Fargo got out clean. Morgan Stanley lost $911 million. UBS, $861. Nomura, $2.85 billion. And Credit Suisse, which had cut his margin, raised his limits, softened his stress test, and paid him $2.4 billion in the final fortnight. Credit Suisse lost $5.5 billion. 4 months later, Credit Suisse published its own investigation into itself. 165 pages. It is not a careful document. It calls the losses the result of a fundamental failure of management and controls. It describes a lackadaisical attitude towards risk. Risk systems that identified acute risks, which were systematically ignored. And one line answers the whole episode. The Archegos risks were identified and were conspicuous. Bill Hwang went to trial in 2024. In July, a New York jury convicted him on 10 counts out of 11, fraud and market manipulation. In November, he was sentenced to 18 years. His chief financial officer got 8. The regulators fined Credit Suisse $268 million by the Federal Reserve, £87 million by the British. The fines arrived in July 2023. By then, there was almost nobody left to pay them. Archegos had been the first of 2 holes in Credit Suisse's year. The other was Greensill, and the bank never got its footing back. In March 2023, after 167 years, Credit Suisse was sold to UBS in an emergency weekend deal arranged by the Swiss government.